Hi candidate, welcome to another session of manifested online classes. So in this session, we continue with the topic of international public accounting standards, and specifically we look on IFRS 31, which basically prescribes the accounting treatment of intangible assets. So when talk about the intangible asset, generally these are those particular assets which lacks any physical substance or which lacks any physical existence, and therefore IFRS 31 basically prescribe the manner in which those particular assets should be recognized, should be measured, and also should be presented in the statement of financial position of the public sector entities. Maybe first of all we can say here that IFRS 31 prescribes accounting treatment of all or basically of intangible assets by public sector entities. Then from there we can also look on the scope of this particular standard. A scope of IFRS 31. So when talk about the scope here, basically we are talking of those particular intangible assets which are covered by this standard. So and we can say that IFRS 31 covers all or covers the following intangible assets. The following intangible assets. So number one, we have software. Number two, we have the trademarks. Number three, we have copyright. Number four, we have the patent rights. We also have licenses and so on. So basically what that means is that if a public sector entity own any of these particular intangible assets, then such intangible assets should, number one, be recognized, be measured, and also be presented in the financial statement in accordance with IFRS 31. That's what we mean by the scope. These are basically the standards to these are the assets, that is intangible asset, to be recognized and also measured in accordance with this particular standards. So then from there we can define what is an intangible asset. So let's define what is an intangible asset. Intangible asset, which generally we have said that this is a particular asset which majorly lacks physical existence. Like what we know is that software, trademarks, copyright, and so on, these assets do not have any physical existence. So therefore, we can say intangible asset. This is a non-financial asset. And financial asset that number one lacks physical substance. Number one, we say it lacks any physical substance. Number two, it is also controlled by the entity. Or in this case we can say controlled by the entity or controlled by the public sector entity. And number three, it is expected to generate future economic benefits. benefits. So that is the definition of intangible asset. Any non-financial asset which lacks physical existence, it is controlled by a public sector entity and is also expected to do what? To generate some future economic what? Benefit. Then from there we can also proceed and look on something to do with the recognition criteria. Recognition criteria. Recognition criteria. When talk about the recognition criteria, here we are talking of the conditions which must be, or which an intangible asset should meet for it to be recognized in the books of account and also in the statement of financial position of a public sector entity. And actually in this case we have two conditions, but first of all we can say for an intangible asset to be recognized, recognized as an asset, it must meet the following criteria. Number one, we say its cost must be measured reliably. Its cost must be measured reliably. Its cost must be measured reliably. And number two, it is probable. It is probable that future economic benefits associated with the asset, the asset will flow into the entity, So therefore, if an intangible asset meets those two criteria, or in other terms, those two conditions, then it has to be recognized as an asset. Then next we can look on something to do with the initial measurement. Initial measurement is all about the value at which the intangible asset should initially be recorded in the books of accounts of a public sector entity. And in this case, we can say that intangible assets are initially recognized at cost. So basically this is the amount which has been incurred by a public sector entity in terms of acquiring, in terms of producing a certain intangible asset, initially recognized at cost, and all direct related cost for producing or basically bringing an asset to its intended use, use. So all the intangible assets should initially be recognized at that particular cost plus any other direct cost related to producing or basically bringing an asset to its intended use. So then from there we can look on the subsequent measurement. So when talk about the subsequent measurement here, we are talking of how, or basically the value at which now this particular intangible asset should be recorded in the statement of financial position of these public sector entities at the end of each year, of which, according to this standard here, that is IFRS 31, a public sector entity may decide to use two models, of determining the value for subsequent measurement. That is a cost model and what we refer as a revaluation model. So we can say a public sector entity, may adopt the following models, for determining, or actually for measuring intangible assets. So which are those models? Number one, we have the cost model. And under this particular model here, the intangible asset should be recorded in the statement of financial position at their cost minus the accumulated amortization. Which will give us the carrying amount or the net book value. Basically, the carrying amount of the net book value is that value at which now the intangible assets will be recorded in the statement of financial position. Number two, we have the revaluation model. Basically, this particular model here, what happens is that the value of intangible assets will have to be revalued at the end of each year, and that revalued amount, or that fair value, is the one at which now an intangible asset will be recorded in the statement of financial position. Then from there, we can also look on something to do with the amortization of intangible assets. So when talk about the amortization of intangible asset, this is a process of gradually writing off the cost of intangible asset. And according to IFRS 31, the cost of intangible asset should be amortized over the expected useful life of an intangible asset. So therefore, you can say the cost of intangible asset should be amortized over the expected useful life of intangible asset. It is also important to note that this particular amortization of intangible asset in a certain financial year then should be recognized as an expense in the income statement, and specifically this particular amortization can be classified as part of what? As part of the administrative expenses. And I think finally we can look on the disclosure requirement. Disclosure requirement of intangible asset. When talk about the disclosure requirement here, we are talking of the information to be disclosed as far as the intangible asset are concerned, as either part of the notes or as part of the financial statement. So some of the information which need to be disclosed as far as the intangible assets are concerned include the carrying amount of intangible assets, of which the carrying amount here we have said is equal to the cost minus the accumulated amortization. So the other information which also need to be disclosed as far as the intangible assets are concerned is the accumulated amortization. And number three is any impairment loss any impairment loss. So basically an impairment loss should be recognized, this one, when the recoverable amount of an intangible asset is less than the carrying amount. Basically, the recoverable amount is the amount which now an entity, a public sector entity, can get after selling what? An intangible asset. So if this particular amount has reduced below now the carrying amount, then an impairment loss should be recognized as the difference between the carrying amount minus the recoverable amount. So the other information which also need to be disclosed as far as the intangible asset are concerned is any restrictions on the title of intangible assets. The title of intangible what? Assets. And finally, the other information which need to be disclosed is what if the accounting policies adopted by the public sector entity to account for intangible asset. For example, the public sector entity will need to disclose whether it is accounting for intangible asset using the cost model or the revaluation model as provided under IFRS as provided under IFRS 31. So basically those are some of the concepts you need to know as far as the IFRS 31 is concerned. And before we wind up, I want to give some questions here which you can be able to use for your revision purpose. So the question reads, in context of IFRS 31, describe the following. Roman 1, the scope of IFRS 31 which governs the accounting, recognition, measurement of intangible asset, 4 marks. Roman 2, you are required to describe the recognition criteria for intangible asset. Actually there you are expected to highlight some of the conditions to be met for an intangible asset to be recognized in the financial statement of public sector entity. And Roman 3, describe the disclosure requirements of intangible asset, which information need to be disclosed by public sector entities as far as the intangible asset are concerned. So that is today's assignment, and basically also that brings us to the end of that particular session as far as the IFRS 31 is concerned. So for now is a bye. See you in the next session.